Hello, fellow real estate enthusiasts. I'm Richard Montano, your host of the Loudest Silent Partner, the ultimate podcast for savvy investors who want to diversify their portfolio with passive investment opportunities. Join me as we unravel the secrets of successful real estate investing, where knowledge meets profit. Whether you're a seasoned pro or just starting, we've got insights, news, and inspiring stories you need. Let's turn the page on your real estate investment journey together. This is the Loudest Silent Partner, where your investments speak volumes. Well, so transitioning into another aspect of what I wanted to share with our listeners is when they're working with someone like me or a company that does real estate syndications, general partnerships, things like that. When they, what should they expect with regards to taxes? So for example, they get maybe distributions or income between an S corp, a C corp, an LLC. What should they expect from each, and does that change anything on their end?
So they're investing in an entity, so to speak. Yep. So yeah, we're talking about entities. There's different types of entities, just like you talked about. We got C corps, we got S corps, we got partnerships. Okay, you mentioned LLC, but LLC isn't. There's no taxable form technically on the IRS side for an LLC. You kind of choose how you want to be taxed when you form an LLC. Okay. Mm-hmm. So if you form an LLC just by yourself, by default, you're a single member LLC and it doesn't really have a federal filing. It's disregarded for tax purposes. Mm-hmm. In the context that you're talking about, most likely if it's an LLC, it's going to be taxed as a partnership, and you're going to be getting a K-1 from that, okay? It's what a K-1 is basically the partnership telling you what you should put on your tax return for your share of the income or loss, whatever it may be, that the partnership did for that year, okay? S corporations, that's also a pass-through entity, so you will get a K-1 from an S corp as well. A C corporation, no, you will not get a K-1 from a C corporation. You're basically buying stock. It's like buying what we talked about earlier, Apple. It's like buying Apple stock. Apple doesn't send you a K-1 at the end of the year. You get a 1099 DIV, hopefully, but you don't get a K-1 from those C corporations. Essentially, is what it is. So, for most of it, you kind of are giving K-1s to everyone from what we've done in the past is how it works.
Yeah, we're typically LLCs, and for the businesses we're S corps,
right?
And so they're always K-1s. But interesting enough, you said 1099 DIV, mm-hmm. And that only happens if there is a dividend or distribution. Is that right?
Yeah, that's typically because there's exceptions to most rules, but typically it's just from a C corporation that you would get a 1099 DIV is how it would work. And it's just it's just the dividends that you receive during the year that you got to put on your tax return, essentially, that you're going to get taxed on.
Mm-hmm. And if there's no distributions, mm-hmm. then you should expect nothing. I mean, maybe reporting or something from the GP.
Unless they're being reinvested. Okay, so there are times where dividends are reinvested, so you don't technically receive them.
Okay.
But because you could have received them, if you opted into receiving them, the IRS will still tax you on those. Is how it works on those dividends. Okay. So if you don't receive any dividends, though, you will not receive a 1099 DIV, though.
Okay. So if a corporation has a profit, mm-hmm. That profit is considered distributable. Is that the case, or
we're talking about just with C corporations? With C corporations, what happens is it has its own tax filing and pays its own taxes, has its own tax brackets and everything. Is how it works. So if a C corporation has income, they're going to pay tax at the corporate level on that income. Okay, mm-hmm. That money does still not belong to the owners until there's an actual dividend paid out at that point. Okay, and then the owners will get taxed on that dividend. That's where the word, we've talked about before, double taxation. That's where double taxation comes into play. The corporation pays its tax, makes the dividend distribution, and then the shareholders pay the tax on the same money, essentially what it is. So it is a double taxation. Not very tax efficient, but for large companies, that's kind of their best option. That's really what it comes down to.
Okay. Wonderful. That all makes sense. I want to go back to 1031 exchanges. Mm-hmm. 1031 exchanges, I love them, and they've been fun to, I want to say, play with over the last 12 years. Yeah. And I talk to clients about like the rich getting richer, and how that happens in real estate. So they say, well, how all the people I know that that made a lot of money and built up a tremendous amount of wealth, they made their money in real estate. Mm-hmm. Kroc, with McDonald's, right? It's like, how did he make his wealth? Real estate, right? Everyone thinks it's burgers, but it was real estate. So the rich get richer doing that. But one of the methods that investors use is 1031 exchanges. So those 1031 exchanges are, where you sell a property that has a potential profit, like a capital gain, but they defer taxes by investing in another property, right? And it's 1031 exchange. So I was hoping that you could help us, understand a little bit about, the rules there and where people can actually make mistakes, like slip-ups, things like that.
Yeah, no, for sure. 1031 exchanges we've been dealing with a lot lately. It's kind of funny about 1031 exchanges. You can kind of see how the market's doing or has done in the last couple of years based on how many 1031 exchanges that I get, We weren't doing any in 2008 through 2012, no 1031 exchanges for whatever reason. But yeah, 1031 exchange, it's a great tool. It's a great tool. It's where it fits in with a lot of clients is they like real estate, they love real estate, but they don't like the property they're in, or they want to change locations. They'd rather have this property over there. A lot of different reasons why 1031 exchange, but that's usually what I'll run into is they like real estate, but they want to switch to a different property and they don't want to pay the tax, So the 1031 exchange, it's a tax deferment is what it is, first of all.
Yep.
Okay. You're not getting out of tax. You're just deferring that tax to the next property that you're buying.
Right.
And then with the 1031 exchange, it's only from one investment property going into another investment property. Okay. You can't have your own home, going into an investment property or vice versa. Okay. It's got to be investment property for investment property. Okay. So that's the first thing to realize. And basically how the mechanics of it work is the IRS wants you to be in the same shoes as if you were in the previous property. Okay. So if you sell that property, you have to at least have the same amount of debt that you did with the previous property. You have to have the same value or more is essentially how it's working. You can go up, but you can't downsize with a 1031 exchange. Is kind of a way to look at it, kind of a simplified way to look at it. And basically any gain that you would have had on that sale gets deferred and reduces your basis in the next property, essentially, is how it works.
So let's do an example really quick.
Sure.
So let's say your basis is $100,000 when you sell your relinquished property. So you sell that property, you're going to do an exchange into the next property, and say the property was $200,000. So your $200,000 property, you sell it and you buy another property. Does the new property have to have a value of $200K plus, or is it you have to have a basis of $100K plus?
It goes into the value, essentially, is what it is. So if you had that $100,000 basis property with basis in that property and it sold for $200,000, okay, you had to be looking for a $200,000 property or higher typically. And if you had debt on the property, then you had to be looking for that same amount of debt unless you're going to put more money into the deal, essentially, is how it is. So if you do, let's just kind of walk that through. You bought the property for $100,000, you're selling it for $200,000. Normal world, you're going to have a $100,000 gain, essentially, right? Because you made $100,000 on the property.
Right.
But you decide not to do it. You do a 1031 exchange for another $200,000 property. The basis in that new property is still the $100,000, even though it's worth $200,000. So if you were to sell that second property that you went into, that gain is still there to be had.
Yep.
Is basically what it is.
Yep. So if you sold that property a few years later for $300,000, your capital gains is $200,000.
Exactly. It's not the appreciation just on the last property. You got to look at the appreciation from the first property all the way through. Is how it is, and you got to keep track of it. You're required to keep track of it.
Yeah. And how are you able to increase your basis when you do those exchanges? What can you do to do that?
Yeah, increase your basis. You can put more money in, would increase your basis. Get more of a debt out on the property, that would increase your basis essentially, or make improvements on the property. All those things will definitely increase your basis. You don't want to, but still money out of your pocket. But if you put money into the new property, that's going to reduce your gain down the road is how it's going to work.
Mm-hmm. So when you do the exchange, say the same example, you $200,000 and you buy a property that's $500,000. Mm-hmm. Your basis that you came in was $100,000. You had $100,000 of debt or whatever profit. Sorry.
Right.
So does the basis change now that I bought a $500,000 property?
Yeah. So you basically get to add on the increased value, kind of in simple terms is basically what it is. So if it's a $500,000 property, basically that $100,000 gain that you deferred from the first property is going to reduce the basis down to $400,000. Essentially, is what it's going to be. So that $100,000 gain that you deferred is still going to be intact when you do sell the property down the road.
Yeah, yeah. So no matter what, you're deferring that capital gains and kicking the can down the road.
Exactly. That's exactly the good analogy. You're kicking the can down the road is what you're doing, which is great because your buying power is so much more if you do a 1031 exchange when you're avoiding paying those taxes. Because if you have 35% of it going to California and federal, for example, if you're in California, that's a lot of buying power that you're giving up. You're giving the government money and it's reducing what you're able to get. So it hurts your investment income in the long run because you have less investment dollars. So is the way to look at it.
Yeah, absolutely.
Yeah.
And so now when you go, and this is what, going back to my early intro here about the rich getting richer, you have a couple that's now doing this, exchanging into the future, kicking that can down the road. And, as we do pass away. So now they both pass away and the property is now left to the children. Now we have a different issue, a different taxable issue, right? So now we've got this, let's say, property that's now worth a couple $1,000,000. Right? They started out at $100,000 over their adulthood. Now it's a couple $1,000,000. Now the children are going to inherit that property, right? So the parents never paid capital gains taxes.
Correct.
Now what happens?
So we're talking about inheriting a property and the rules about that. Now, when kids inherit a property that like you're talking about, it's they get a step up in basis is what it's called. Now, what that means is they don't get the basis that the parents had, starting at that $100,000 years ago. Okay. Their basis when they inherit it becomes $2 million now. Okay. So a lot of times if they inherit a property and sell it, you're not going to have any gain. Most likely you have a loss because of transaction costs and things like that. So it's a great tax planning to die. It's great tax planning is what I tell the clients because the beneficiaries really get a huge. It's one of the best things that the government offers, probably in the tax code, in my opinion, is that step up in basis because you get fair market value as your new basis, and you can do what you want with it. You can depreciate it at that point. So now we're taking depreciation on $2 million as opposed to the $100,000 that we had before. So which will offset a ton of tax. It's a lot of depreciation that you're able to take and offset taxes. So it's a great benefit. And a lot of people don't realize the rules, unfortunately, because there's a lot of times where clients come in and go, I deeded my house, older client, I deeded my house to my kids because, and it's like, why did you do that? Why don't you come talk to me about that? Don't do that. I've got better tax planning for you. I don't want to tell them my tax planning is that you die, but there are better ways to transfer property, to different generations for sure.
Yeah.
Make sure you see your tax guy before you start willy-nilly transferring properties to family members.
Absolutely. Yeah. I mean, in our conversations, a lot of times I'll call you and I just have some wild question, that I'm asking. And it's really because I value your professional, experience and knowledge. I mean, it's, I don't do this stuff every day. And so, hey, here's what I'm considering doing. Is this okay? I mean, you and I play scenarios a lot.
Yeah, for sure.
On the phone. And it's fun. I kind of geek out on this stuff, right? Like,
it's like a test almost when you call,
What do you know?
Okay, what if I do this? It's like,
yeah, a lot of what ifs. That's true.
But hey, you got to explore the rules. You know what I mean? Without having and asking the questions about different scenarios, how are you going to know what you can and can't do? To your credit, man, that's what you've always looked for, the out of the box things and tax savings or investments or whatever, and it's worked for you well. It's worked for you well.
Yeah, it's worked, and I've learned a ton. I mean, I just a forever student. You're one of my teachers. I mean, it's just just learning how to increase wealth and value over the course of the last 12, 15 years is you've been essential in that process, and I think I hope all our listeners work with you, but also, I just hope they have someone that can help them with this.
Yeah, that's the important thing. I mean, even if it's not me, that's fine. Trust me. I've got a lot of great clients, and there's a lot of CPAs there that have a lot of great clients too. It's not about taking clients, about them paying what they should pay. Unfortunately. So just talk to your tax professional before you do any major transactions like that. It's amazing every year that the things that a client will do without talking to me first. You know, it's just like, come on, how long have we worked together? And you did that without talking to me, you know? But, you know, and especially in this day of, you know, TikTok, you know, I get TikToks forwarded to me and it's like, and, you know, we respond to them and tell them, yes, that's true, but this usually goes, yeah, that's true, but, you know what I mean?
Right. It's not considering
how the conversation goes.
Yeah, it's not considering all of these other potential issues or rules or things like that.
And that's one thing to always remember is, you know, your tax return is not the same as your neighbor's, you know. Because your neighbor got a huge refund doesn't mean you're getting a huge refund.
Right.
So we hear that a lot of times too.
You know, and I digress a little bit here, but you know, the return, the refund, and I love hearing people when they talk about the refund. I go, well, you know, you paid that already. That's money you put in that you're getting back. This isn't like free money.
Yeah, I mean, I kind of get it. You know, it's kind of a savings account for a lot of people. Yeah. They don't spend it themselves. Yeah. They get to take a vacation in April when they get that tax return. I get it in a lot of situations. But yeah, when people get angry that the refund wasn't bigger, it's like, well, you know, it's just money from here to there, you know, is what it is. And you can always change your W-2 withholdings if you want more. And, you know,
I call it efficiency if you don't get a lot back. I mean, I'd rather hold my own money. Than to give it to Uncle Sam to hold on.
Well, now that interest rates have gone up currently, you know, I mean, actually, it does make sense to get all your money and put it in a money market or something like that. It didn't make sense necessarily, you know, a couple of years ago when they're paying 0.02% or whatever those savings accounts are paying. But now I get it. Yeah, I mean, it's your money, and the banks will give you a decent rate now.
Mm-hmm. So, you know, talking about tax planning. So going back to that 1031 example that we just did. You know, we have, I talk to clients about this. Like, you know, well, let's exchange. Let's go to the next one. Let's defer the taxes and let's just keep going. Let's just build wealth. And they said, well, again, you at some point for the real benefit to happen is you have to die, right? So that the family now inherits the property at a higher basis, right? So they say, well, I don't want to wait for that. I worked hard for this. I want to be able to, you know, enjoy the growth as well, the equity growth. And so the options are, and one, and you can probably elaborate on this, is refinance. You can take a cash out loan, and which I believe is not taxable.
Yes. So if you are taking on a debt and you're getting money, that is not a taxable event because you got to pay that money back, essentially is what it is. And you're paying interest on that as well. So the IRS doesn't tax you on, you know, cash out refis, correct. That's not a taxable event. It's not free money, but it's money that you can take advantage of that you don't have to pay tax on. Yeah, right. Absolutely.
Yeah. And then also, you know, you can buy something else if you wanted to.
Yeah. Leveraging properties. That's all. I mean, I think it always depends on where you are in life. You know what I mean? Are you trying to expand the kingdom or not, you know? But yeah, leveraging from one property to get another property is a great strategy. If you're thinking long-term, it's kind of a no-brainer, you know? Yeah. I think that's a good way to expand the kingdom, so to speak.
Mm-hmm.
Yeah.
Now, other means of expanding the kingdom. I love this. I'm going to take this home today. Is, you know, taking a 1031 exchange into something else. So we have options. We have the basic, straightforward is I sold a house. There's a capital gains. I want to defer that. I buy another house. Mm-hmm. Now there is a way and a means to actually invest passively by also closing a 1031 exchange. And so there's what we call DSTs. Mm-hmm. There's TICs. So Delaware Statutory Trusts and tenant in common investments. So you could actually complete a 1031 exchange with those. We do those. We've done them, you know, over the last few years. They've worked out really great for clients. So I would love it if you could elaborate, you know, like, especially like Delaware Statutory Trust. Mm-hmm. Like, you know, what is that? What actually is that? So let's understand what that is. You and I both know, but our listeners may not. So what is it? What is a DST, and how is that beneficial to them, and how does it work?
Yeah. So DSTs are a great tool. You know, they work best in certain situations, I would say. And what, like you said, Delaware Statutory Trust is what they are. It kind of reminds me, and without getting too legal into it, it kind of reminds me of a TIC, to tell you the truth. Mm-hmm. Whereas you are taking your house that you're selling, You're saying, I don't want to manage it anymore. I'm retiring. This is where I don't want to go collect rent. I don't want to go fix this guy's toilet whenever he's having issues. I don't want to do that anymore. I don't want to deal with it. So basically, you want to sell that house. You don't want to pay the taxes because you're going to take a huge tax hit because you've had that property forever.
Yep.
Okay. What you can do is preserve that fair market value and invest that fair market value that you're selling the property for. Okay. You can put it into a DST or a tenant in common situation, or just a bigger project where it's managed. You don't have to do anything. The return on investment is typically higher than it would be for California property, for sure, because California real estate, as you know, doesn't have great ROIs typically, and it's kind of like a dividend or mailbox money that you're getting, really, at that point is what it is. So it takes the headache out of it. You don't pay the taxes, and you get that same income coming in on a monthly basis, and usually the income's actually a little more because you get a better return on investment. Same things apply where you still get depreciation as well. So it's still, even though you may receive, let's say 10 grand, you may only get taxed on 8,000 of it, which is another great thing because you are getting depreciation still in the DST. Another great thing about those DSTs is the IRS, if you do have a loan on the property, the IRS lets you assume some of the DST's debt to satisfy that loan requirement on the 1031. So even if you have a loan on the property, you can still do that DST. They're good deals in the right situation, in the right situation.
Now, you said you can assume some of the debt that's on that DST. Is that, are you able to elect how much of that debt you can take, or is that something that's done by each DST? Yeah,
the DST managers kind of handle that. I'm not sure the mechanics behind it exactly, but basically what they do is they assign you a portion of the debt. Are you asking about taking money out? Is that kind of where you're going with that?
No, I was really referring to kind of meeting the ratios of, say, for example, I have $100,000 of equity and $100,000 of debt. Mm-hmm. So the DST has, let's say, 30% equity and 70% debt.
Right.
Do I need to modify my assumption of any of
No, they don't. They typically rearrange it. And again, I'm not 100% on the mechanics of how that works, but they're able to rearrange it to fit your, debt to equity ratio, basically is what they do. So you don't take on a different debt. Basically how it works is you're investing your equity, essentially, is how it works. And you're able to do that by them assigning you a certain portion of the debt that they already have.
Yep.
Yeah. Because you can't, like we talked about before, if you're relieved of a debt, that's like income is basically how it's treated.
Yep.
So yeah, that would be that would be another great thing about the DSTs. Even if you have debt on the property, you still can avoid that tax hit by going into it. So it's great.
Yeah. So you said they're very similar, DSTs and TICs, in that regard. Mm-hmm. But I prefer TICs because there's a lot more flexibility. DSTs have a lot of regulation.
Yeah, true.
So for example, they can't change their debt after the property, after the investments have been taken. So they're not allowed to change their debt. So with TICs, we can, which is wonderful because we've done it before. We've had to deal with this issue in the past where, where we've had an investment, we've done an exchange into a property, and now it's a TIC, and then we had to refinance later, new debt. So we didn't have to sell the property. We weren't forced to sell the property because of, our debt expiring and things like that. So what are your experiences with tenant common investments with clients, and do you prefer one or the other? I mean, I know what I prefer on my side as a sponsor syndicator, but from your perspective as a tax advisor, which one do you prefer?
Well, yeah, the TICs are better in what you talked about. The flexibility, is basically what it is, and and I'd say it's better in the situation where I don't know if it's more intimate. I would say, hopefully the property manager better, or the person like yourself putting it together. When you go deal with the DST, it's probably you're dealing with someone that you probably don't know necessarily. Whereas with a TIC, it is more flexible. Mm-hmm. Hopefully, the management a little better, like yourself. You know what I mean? So all else being equal, the TIC would probably be the way to go. I would agree with that.
Mm-hmm.
Yeah.
And going into the TIC is one thing, right? And then now, like, let's say we sell the property, the person can exchange out of it.
Right. So with a 1031 exchange, you cannot 1031 exchange a partnership investment, so to speak. So if you own a partnership, you can't do a 1031 exchange of that partnership investment. Now, the partnership can do a 1031 exchange, okay? But you can't go into a different partnership, essentially is what I'm saying. Whereas a TIC, like you're talking about, you actually are a tenant in common, you own a piece of property, and when that property sells, you can do whatever you want with your portion of that property sale, which is a great benefit. So yeah, in that sense, the TIC is great as well.
Yeah, and you know, the TIC option has become actually something that I've shared with a lot of other brokers and real estate professionals in my space.
Mm-hmm.
It's now becoming a creative way to move through this current market. So I was actually on the phone, I think it was last week, with a very successful brokerage group. I mean, they do billions of dollars of sales a year. And they were trying to figure out, because their sales have gone down 80%. 80% reduction. So their whole team, I mean, imagine losing 80% of your income, you know? And these guys are trying to be creative. They're saying, what do we do? How do we handle this new market? And I said, well, guys, let's work on a deal together and let's do a TIC. Mm-hmm. And they said, well, we know of TICs, and, you know, they've heard of TICs in the DST sort of space, like, you know, with where big firms were doing tenant in common investments, but they weren't familiar with it in the smaller space, which is, you know, again, like you said, I think out of the box, I was doing big corporation, big fund ideas with a little bitty shit. And we were able to make it happen. So I said, you know, we can do this. We can do with these partial sales and help sellers and buyers move with deferred tax situations, doing 1030 exchanges, and then the brokers can still make money with these sales. And so it's been an interesting space to work in, because I've been sharing this information, which I feel like it's not new, but it's new to the smaller shops.
Well, you take the rules and you apply them to things that people don't think about, you know, is what I've kind of found with you. So yeah, I mean, I've even learned some stuff from you, honestly, over the years. I never thought about that. And yeah, that would work. So you're creative, man. You're creative. I love it.
Well, you know, I think, I mean, you know my story, and I don't want to create like some sob story here, but, you know, when you come from nothing, you've got to be feisty. You got to figure it out. You know, you got to make a way by doing something honestly, right? Like you said, I look at the rules and see how I can apply them. Mm-hmm. You know, and I truly believe in taking the ethical and moral route. But how do we get to accomplish those types of things with what we have? Mm-hmm. And you know, and so, you know, we hear a lot about these investment groups online, and, you know, YouTube, TikTok, et cetera, where they're saying you can become a millionaire with no money down and all these things, and just take our class, right? You're broke and you need to make money, pay $10,000
for
our class. Yes. You know, and honestly, you know, being frank with you, this is one of the reasons why I wanted to start this podcast, was because those people spend all this money to take these classes, and 90 some odd % of those people don't do anything with it afterwards, because they can't.
Yeah.
Because what's being sold to them is actually not realistic, right? And there are some rare occasions that things can work out, but for us, what we've done for clients is we've actually said, well, you have $50,000, $100,000 to invest. Okay, that's not going to give you an investment property in San Diego, right? But maybe you can invest in a deal with us, right? Mm-hmm. And then you can grow, you can continue being the dentist that you are, the phenomenal, great dentist that you've been over the last 10 years. Now you give me $100,000 in one of my apartment buildings, and then you know, we sell it in 3 years, and now you've got $130,000, right? And you can do that again, mm-hmm. And now you have this one investment that's now growing for you. And at some point, you can take that $350,000 or $500,000, whatever it becomes over the years, and then you can say, okay, well, I'm going to take that money, and by the way, Rich, can we move it into a TIC? And we can separate their investment out into a TIC, and then we can sell, and they can do an exchange into another property. So we've talked about that a little bit. Mm-hmm. And what are your thoughts there? Because I know I kind of pushed the limits a little bit on creativity. What are your thoughts there?
Well, yeah. I mean, if you're getting back to what you're saying, you got to start somewhere, you know, is the way I would look at it. I mean, I bought my first piece of property with a loan from my dad. You know what I mean? That's mm-hmm. That's how I got started. You got to start somewhere. But yeah, I mean, just keep the money moving, you know, and real estate in the long term is going to do you well. There's obviously the downturns like we've had, you know, in 2008 is the the major one that we had to go through, and we're still here. You know what I mean? Where a lot of people aren't. You know, it took down a lot of people in the real estate. To your credit, you're still here. You know, so that's great. That's awesome.
Oh, I mean, what was funny is, you know, I ran from I was an aerospace engineer, right?
Yeah.
You know,
Oh yeah.
Physicist.
I remember
at a very well known company, and the market was crashing, and I looked at it and I said, this is where I'm going to be anyway, and so I ran into the fire. Everyone's running away saying, get out. You know, it's
all right.
And we jumped in, and it was, you know, I went from a very substantial, wonderful income, and then went into this real estate space. And first year, my income was not even half.
Yeah,
it was way, way lower. And so, but I don't regret it. I actually, to this day, I still jump out of bed. I'm still excited about it.
You enjoy what you do.
I enjoy what I do.
Yeah.
You know, and it's, like going back to the saying I said in the beginning, you can't get rich counting other people's money, but I sure as hell enjoy when my clients are making money. So I love counting their money for them. Right. That's something I truly appreciate that. Gosh. Yeah. Well, Ethan, this has been like awesome. You and I, this is like one of our phone calls,
We're done already?
This has been like really, really great. And, yeah, so truly appreciate you. Thanks for joining me. And
well, no, I appreciate you having me, Rich. Yeah, I always enjoy our phone calls, and we're both busy, so it's hard to get us on the phone at the same time. But yeah, it's great when we're able to do it. And I never told you this, but you reminded me. One of my favorite stories that I tell the clients about why they should save taxes is the one you told me about when you were selling engines for Northrop Grumman back in the day. I don't know if you want to get into that, but I want to just, I use the story with a lot of clients. I give you full credit, of course. But it's one of my favorite stories. So I enjoy the conversations for sure.
Oh yeah, we can go all over the place. Yeah. That's for sure. That's for sure. All right, awesome, brother. Well, thanks a lot, man.
No, thanks for having me. Appreciate it. Thanks.